Hello, Profit First entrepreneurs and thought leaders. I am so excited today. We have a special guest with us. We have entrepreneur Lane Kawaoka, and he is joining us today. Lane is a licensed professional engineer. He has a master's degree in civil engineering with an emphasis in construction management, and he also has a bachelor's in industrial engineering from the University of Washington. Lane is an engineer, and in his everyday job, he manages over $230 million of capital construction projects. And these are both in the governmental sector as well as the private sector. And aside from his day to job, Lane controls over 7 manufactured home parks and 16 apartment homes and 1 assisted living facility. So Lane is quite the busy guy. And he's got over 3,000 units in 8 U.S. markets. Lane is the founder of crowdfundaloha.com and simplepassivecashflow.com. Lane is responsible for finding investment opportunities and conducting analysis and marketing. And while working as a high-paid professional engineer in corporate America, Lane became really frustrated with the traditional wealth building dogma. And so he was inspired and compelled to mentor other working professionals. And he does that through his top 5 investing podcast, simplepassivecashflow.com. That's simplepassivecashflow.com. Please welcome Lane Kawaoka to our platform. Welcome, Lane. How are you?
Hey, thanks for having me, Suzanne.
Yes, I'm very excited. This is a topic that a lot of our listeners are very interested in hearing about, especially when they've been working at Profit First for a while and really pivot their businesses, right? They are now dealing with cash flow that they have never seen before. Massive retained earnings, massive profit, higher owner's pay. I usually find they have 2 problems that they come to deal with at the end of their Profit First journey. One is they've got a tax problem because they're now in a much higher tax bracket than when they first started out with. And second of all, they're like, how can I make all this cash working for me, right? How do I make it work for me? Because, if you put it in a bank, you earn like, what, a penny for every $1,000? And so, Lane, speak to us about investing. How
Yeah,
did you
so
get into it?
yeah, so I started right after I graduated college with an engineering degree. I followed all the mainstream advice of saving your money and then buying a house to live in, which I don't really recommend, and maybe we can talk about that later. But I was living in this big house. It was $2,200 a month for the rents to rent it out, and my mortgage was $1,600. So to a young 20-something-year-old kid, that was a lot of beer money back in 2009. And because I didn't really like my construction supervisor gig back then and wanted out, I was like, wow, this is my ticket out of the rat race. If I just save up more and then rinse, wash, repeat, keep doing this, I'll be financially free, right? My income, passive income will exceed my expenses at some point. Fast forward, a lot of lessons learned. Had 11 rentals in 2015, and that was where I found how high net worth investors and accredited investors invest in private placements and syndications. And then 3,500 units today, and left the day job on the engineering job, not doing that anymore.
Congratulations. That's a big leap, right? That is wonderful. So how did you get into this real estate? How did you hear about that?
Yeah, I mean, at first it was just like I didn't know anything, right? Like I made so many mistakes. Like I bought my first rental where I lived, which isn't necessarily where you want to buy. You want to buy where the numbers make sense. You don't want to buy in primary markets like Seattle, all of California, Hawaii, Boston, New York, because the numbers don't make sense. We're trying to find properties that are at least 1% rent to value ratio or higher. If you want to go on Zillow, it's okay resource. You take the monthly rent divided by the purchase price, and you're looking for something that's 1% or higher. That's usually the indicator that you're going to be positive cash flow. I went after A-class rental initially in a primary market, everything you're not supposed to do. But I just kind of continued and trying to find better investments down the road, and then just you get better over the time.
That is really neat. That is really good. Tell me about managing these properties. What is it like in terms of like the everyday being able to manage that, especially with, I know a lot of our entrepreneurs, they have regular jobs. They're, in terms of like their companies, how is that day to day?
Yeah, I mean, initially I was just using property management. So you pay these guys, normally 10% of the rental revenue, and they kind of take care of your day to day for you. And really, they only give you a phone call or email whenever something, big breaks and you have to approve purchases. But once I went to private placements and syndications, you don't do anything, right? You're a passive investor in LP. You have an asset manager that has skin in the game. They're a partner, They get paid off performance and they manage the property manager. So it's an extra layer in there. So making passive investors do absolutely pretty much nothing.
Very nice, very nice. So I'm going to ask you this question because you're using some big words, and I know what they mean, syndication, because done that type of work before with securitizations and stuff like that. What do you mean by syndication, just for our listeners to know what that means?
Yeah. So like, most people think of real estate investing as you buy a rental property, right? And that's how I started. That's how I got up to $500,000, $700,000 net worth doing that. And that's what I recommend, if you're under $500,000 net worth. But at some point it becomes unscalable, right? Because with 10, 11 rentals, I was having an eviction or two every year, some kind of big catastrophe every quarter, which is fine. But for 10 rentals, that's only a few hundred, at a few $100s per property, that's only $3,000 a month, nothing that's going to change anybody's life. So you're going to need 30, 40, 50 properties, and that's just impractical from a scalability standpoint. So what a lot of high net worth investors do is they go in as a passive investor in what's called a syndication or private placement. These nickname on these are like country club deals, right? So the analogy that I like to use is an airplane. So in an airplane, you have the cockpit, which has all the general partners, the leads, and these are the guys who find the deal. They put it under contract. They get the lending, the loan in all their names. So the passive investors don't have to get any debt in their own personal names. They manage the asset. They distribute funds. They do everything. And the passive investors are like people coming in coach. Some guys coming in first class, but you just pay your way to get on the plane. And typically these investments are $50,000 minimums. And you pay your ticket, you sit down, you shut up, and you cash your checks, right? And go to sleep. And each of these ventures is like an airplane. And it's nice because, just like how you put your trust in your pilot, right? When you fly on a plane, if the plane goes down, the pilots die too. So everybody's aligned, right? For the performance. And, passive investors, they go into, a few dozen of these deals, and that's their portfolio of alternative assets. But the thing is, it's not a retail investment, right? And that's the fatal flaw with most wealth building dogma out there is they want you to go into these mutual fund products that are just garbage, mostly because of the heavy fees. A third of your money is going to their fees.
Oh yeah, definitely, definitely. So this is kind of a way of really hedging your risk, not having to be involved in the day to day, almost like buying into a stock, right? In some way, where you own a piece of this conglomerate of property, right? Am I
Right.
correct with saying that, Lane?
Right. I mean, I'm not a lawyer, but I do think you're pretty much spot on right there. I mean, these deals are securitized through the SEC, but it's very small, right? Like, to buy maybe a 200, 300 unit apartment complex, it might be 50 or 100 investors bringing in 50 grand, some bringing in more. And they own a fractional share of the company that owns said building.
Wow, I like that. That's really neat. And so, I guess as an investor, as a first time investor, right? And traditionally they may have done like Fidelity or one of those Charles Schwab investments. This is a little different and a little scary. Tell me about risk management. Tell me about things that people should be aware of just to know, I guess, comfortable. Is this a safe investment, or what's this going to be like? What is my risk with doing this?
It also is a disclaimer that, yeah, in these investments, there is risk, right? In any investment, there is risk. So it just kind of sets the rules of engagement. And then, like a lot of these deals, they'll use a third party. They're on a few of my deals as my auditor and my third party CPA. So, I mean, we just like to have that separation, somebody checking the books for us, just for investors' peace of mind too. Yeah, so what I recommend for like people who are just totally new to this, like don't do anything for 6 months, right? Just kind of consume all the free content out there. I have a lot of stuff on my website. My syndication guide is simplepassivecashflow.com/syndication. But consume a lot of this stuff and learn like the lingo for about 6 months. But the biggest thing of this is like, how do you get access to these deals is like the next question, right? Well, it's all going to be through your personal network. And this is where a lot of people just don't have the ability to network or have people in high net worth friends that have access to these type of opportunities. And then this is the term where the country club deal come in, right? Because if you're not in a country club, you don't see any of these things, right? And But that's what makes them so special, and why, in my opinion, the risk return profile is way, way stronger than anything you'll get on the retail market.
Right, definitely. A lot of people don't know this about me. I have an audit background, right, from working with Anderson and KPMG prior to starting my own practice. Tell me about like one of the things I always advise my clients, right, because of risk and just making sure they're able to really be able to hedge their risk. And I know for your traditional investments and hedge funds, those go through their annual audits. What type of controls are on the back end for this type of investment?
Well, one of the big documents that's signed is called a PPM, Private Placement Memorandum. So it's this big 100+ page document which gets you the deal registered with the SEC. Now, I'm not a lawyer, but essentially this does two things. It signs the general partners up for fiduciary responsibility. Don't lie, cheat, steal.
Okay.
But yeah, I mean, I would say like the biggest check that you can have is through your network, right? If somebody's invested 50, 100 grand with a team in the past, that's gold. That's worth its weight in gold.
Yeah, definitely, definitely. So tell me about, you said something really interesting before we started talking that you paid, what is it, 4% for taxes?
Yeah, so I invested. I've been investing for quite a while, and people who are selling assets like their stock portfolio, or I was selling 7 of my rental properties because I was just tired of being a single family home renter, and I was transitioning to a more of a passive investor role, an LP. So I was selling off those assets, and I had a $200,000 capital gain. But when I went into these deals, I was getting bonus depreciation from these deals because we were doing cost segregations. So I was walking around with three, four, $500,000 of passive losses. So on my tax form, you probably know this better than I do, but like $200,000 capital gain, and then I brought over $200,000 of passive losses from my
Ching.
gains and zero, right? No, and that's kind of the game that a lot of us passive investors play. We really pay no taxes, in my opinion, because I kind of act as a family office to a lot of my clients. We have professionals doing our taxes, but I'm in sort of the advisory role on when to strategically use those passive losses. And one year, I mean, it makes for a great Instagram like picture that, yeah, you can look at my tax form and it looks I paid 4% effective tax rate. But in actuality, probably should have saved some of those passive losses. I used those passive losses too much. I should have saved it for 3, 4, 5, 10, 20 years in the future, and probably should have paid 14 to 20%. That's kind of a healthy range for most folks. That said, if you're above 25%, you need to get into real estate and bring that down to in the 20% ranges.
Got it. So tell me about, I mean, as a tax accountant, one of the things that's hot right now is the qualified opportunity zones. And, obviously the big thing about qualified opportunity zones is that you can defer your capital gain taxes, right? For, in some cases, up to 7 years, right? And then you get step-up basis after 10 if you hold the property. Tell me about how we could take advantage of those in your investment, or maybe we can't. Maybe I'll let you tell me about it.
Yeah. I mean, opportunity zones they're okay. We can talk about land conservation easements and oil and gas deals after. I think that's really where the cool stuff is. But I think opportunity zones, like you said, like you can defer the taxes, and then the cool thing is if you go the full 10 years on one of these deals, you can just totally wipe it out. And the government wants to sort of guide money into these opportunity zones. But, my opinion, most times opportunity zones are just garbage areas that I don't want to, the joke is they're in the hood, right? I don't invest in bad areas. Just, like I'd rather stick it in a hole and bury it, right? And not find it. Like, don't let the tax guide the investment. Investment first in good, stable deals that meet your criteria. Then if you get some nice tax benefits, cool. So, if you can find an opportunity zone with happen to have a Starbucks on the corner, that's cool, right? But most of these opportunity zones are just garbage areas. So be very, very beware of, those kinds of opportunities out there.
So guys, look for Starbucks. Starbucks, Starbucks, Starbucks. That's how
Yeah,
you know that the neighborhood is changing. Look for a
yeah.
Starbucks. So tell me about easements. Tell me about the oil and gas. Tell me about those things.
Yeah, so for clients of mine who are under, 300, $400,000 AGI, and they're investing in deals that do a cost segregation and get a nice bonus depreciation up front. They're usually good. They usually can knock down their AGI, especially if they're a real estate professional status, and pay, pretty decent amount of taxes. Not too much. But unfortunately, some of my clients, they'll read that purple book, The Rich Dad Poor Dad, find me and be like, all right, I got all this money in my retirement account, which I don't like retirement accounts, so we can talk about that later too. But they're like, I have to take money on my retirement account to invest it and to get all the tax benefits, but unfortunately that shows up as income, right, to your adjusted gross income. An option there is like, if they take out a couple $100,000 and they're already making 300 grand, they're going to be at the $500,000 adjusted gross income, and they're going to get killed, right? Absolutely killed on taxes. So a couple solutions to that they're somewhat controversial, are land conservation easements and oil and gas deals. The oil and gas is controversial too, because some people are, very attuned to the environment, right? But the truth is everything in America is somewhat of a petroleum product, even everything from like plastics. But the government wants to subsidize exploration of oil and gas drilling in America so that we're less dependent on the Middle East. Makes sense, right? From a military and national security point of view. So they're saying, well, if you invest money into these type of projects, you can get what's called indiscretionary or drilling costs, IDCs is the Googleable term, and you'll get like a 1-for-1 credit on what you put in as to deduct off your taxes, and that's even if it's off your active income. That's really cool for people who don't have the real estate professional status. Moving on to land conservation easement. So what people are able to do is you're able to go into a deal that designates a piece of land as a conservation easement. So how this shows up on your taxes is it looks like it's a donation. But the kicker is that appraised value or the donation value is often inflated. Now, some guys out there are definitely abusing this, in my opinion. They're doing a multiplier of 5, 10, 20 times the actual raw land value. I think if you're under 5-time multiplier, you're using the trick, but you're not abusing it. Again, I'm not a CPA or attorney, so this is just infotainment here.
No, it's good. Keep on going.
But, like what guys will do is like, let's just take a guy who's $600,000 adjusted gross income. He wants to get to his magic number of 400,000. So he wants to bring down his AGI by $200,000. So what the game plan is he's going to go into a deal where he gets a 5x multiplier. So he's going to invest, let's just say he invests $100,000. So he gets a $500,000 deduction right there. Probably wants to do a little less, right? Maybe $50,000 to get $250,000 deduction. But, you kind of get a sense of, how you play around with this stuff. It is somewhat controversial, especially this year, because it is on the naughty list. To me, I don't do any of those things because I invest in real estate and I have my taxes under control, and I'm consistently investing into deals. So for me, I don't really get into the exotic stuff like land conservation easements I did it oil and gas just to try it out, but I don't really extensively do that. To me, when I go into a deal and we do a cost seg, I get enough bonus depreciation there, pretty much pad my passive loss bucket to use it strategically when I want.
Very nice. Very nice to be able to take those large expenses up front like that. That's really good. Let's talk about some of the benefits of investing in real estate because, I don't know if that's so much talked about what the benefits are, but maybe we can have that conversation, Lane.
Yeah, so for me, like, why kind of back up? Like, you can invest in anything you want, right? But like my major rules on investing is I want something that cash flows. But especially when I was starting out, like I wanted something to replace my day job so I could quit it. So cash flow is important. That's number one. Number two, it needs to be a hard asset, especially in this environment where the Fed is just printing money, to keep us alive in COVID financially. And then the third, it needs to be leverageable. Real estate's amazing because you have these great government subsidized loans. They're almost begging you to take these loans out and good debt. Real estate's the only thing, or cash flowing real estate, where 1% rent to value ratio or higher is the only thing that really hits all three of those points. And a lot of people in my mastermind, and my clients will bring me these random investments like Bitcoin, right? For example, it's yeah, we could argue all day if it's a hard asset. I'll just concede that one, but it's not really leverageable, and it's not doesn't really produce income, right? Like gold's a hard asset, but doesn't produce income, and it's not leverageable. I mean, you could leverage it in mining stocks technically, but like it's just not like real estate. But those are kind of my big rules of investing, and I'm sure there's some other things out there. I look at some venture capital and businesses, but for the most part, I just try and stay in my lane, which is workforce housing, investments that kind of cater to the bell curve population of America, things that are, as we've seen in the last few months, we do pretty well in a pandemic.
No, that's great. My husband and we have some rental property and definitely not like what you do by any means. We're talking like single family homes. And one of the things that we've always been attracted to it was the fact that real estate typically doesn't lose its value, right? It typically doesn't lose its value. And so that means like when you're ready to sell it, let's say the kids are going to college, if each of them can have a home, right? That you're going to sell when it's time for them to go to college, they're really, hopefully you're going to get everything back that you put into it. So that's like one of the really great things about it. So if you buy a home, I'm going to say a cheap home, like, Texas, you can get one for like 100,000.
Yeah,
Maybe not in Washington, but you're California, but you can definitely get one here. When you sell it, in 10 years, it's going to hopefully be at least 100,000 that you're going to get back.
right.
Hopefully more, right? Because it'll have some appreciation, but it's a relatively stable type of investment, right?
Right. I mean, the drivers are population growth, right? I mean, America is increasing population, especially because of we have great immigrants coming in, and then we have a housing shortage as it is. So, I mean, and also the saying goes, you're not creating any more land, you know, anymore. So there's just so many reasons why real estate is the way to do it. And then when you throw in the tax benefits too, along with it, and the fact that the tenant is paying down your mortgage, so you're getting equity there. I mean, it's just a no-brainer the way I see it. And I think you gave yourself a little less credit than you should. But like to me, single-family homes, and when you're doing it on the small scale like that, is harder than apartments. I mean, with apartments, we have that extra layer of even like of property management, and these are commercial property managers. Like they put like residential property managers to shame. I mean, it's just so much more sophisticated, and on a larger scale, you have the income to control, to pay for more expenses, to run it more as an institutional investment.
Yeah, definitely. That is really neat. I know on a small scale, we'll even have people that'll buy like one home per child, for when they go to college. But this is, I mean, definitely the way you're doing. I think it's a whole lot
Yeah,
easier, right? Just
yeah,
being able to just buy just a small portion in a portfolio
yeah,
and be able to like, and we see these K1s all the time at the end of the year that
yeah,
you guys produce, but just to be able to like just buy it, and just to not have to worry about managing it and just know
right.
that you're keeping your value, it goes far, right? It goes far.
Right. And that's how I invested my first like 5, 7 years. It's just buy and hold. But like, when you can combine that with forced appreciation. So, when we're buying an asset, we're buying it with the ability to put in maybe $5,000 or rehab into every unit. Not much, right? I mean, we're just putting lipstick on a pig. We're just changing out new flooring, getting some new appliances, but we're not getting into heavy stuff like cabinets or anything like that. But what that does is now we're able to bump the rents up 50, 100, $150. And a lot of these commercial assets are not valued like residential properties, where it's what the house sold next to it, the comparable sale method. Commercial assets are based on NOI. And a lot of you guys are businesses. You guys, EBITDA, I think, is the term, and then you multiply it by a multiplier based on what your kind of business you have, and that's your business value. So apartment complexes are no different. So if we can bump up that net operating income by increasing expenses or increasing income, lowering expenses, and well, oftentimes we're increasing the expenses because we're trying to make a better product for the customers, the tenants. You can increase the NOI, which you divide it by a cap rate of 5 or 6, and that's how much value you created. So even if the market is getting worse and the pandemic or zombies next time, if you are forced appreciating that property, you're often doing it a lot quicker than the market can retract. when you're a buy and hold investor, you're in a rowboat without an oar. You're just floating around. The market is taking you, the tide is taking you wherever. But when you have a plan to force appreciate a property, whether it's a single family home, I particularly would rather take a 200, 300 unit apartment building. You know, now you have like a motor on that thing and you have control over your own destiny.
Yeah, definitely. Definitely a lot more sophisticated than what we're doing. I was looking at your portfolio. I think one of the things that's really interesting is you have 7 manufactured home parks. I think that's mobile homes, right?
Yeah,
Homes.
that's a nice way of
Yeah.
saying like mobile homes. I mean, they're not quite trailer park,
That is
garbage,
awesome though.
right?
It's land, right? You're running out. Tell us about that.
Yeah, I mean the business plan of that is like, in theory they're kind of like D-class renters. They're a step below your apartment buyers or apartment tenants. But people need a place to live, right? That's where most people barely make 30, 40 grand a year, and need access to good quality housing. The nice thing about mobile home parks is that we own the land and we rent out the space, but they own their house. So if they want to be absolute pigs and slobs, dude, that's their property. Like the landlord laws are so strong for mobile home park owners. It's unreal. It's almost unfair. I mean, we try and run a good ethical business, but I mean there was like HBO special done recently, like last year, where they kind of poke fun on how like messed up it is to be a tenant there. Like it's so unfair. Like why would anybody do it? But they don't have any choices. Like for example, if they don't pay their rent, we take their house, right? And these guys don't have $500 or I think a low boy must cost like a couple grand to move their house out of. They can't afford that.
Yeah, exactly. Exactly. Everyone starts someplace. So, it's where they're starting, right?
Right? And a
And
lot of, seen as a dirty asset a little bit, but that's why you invest as a passive, right? You don't do anything.
right, definitely. No, I think it's genius. I mean, you're buying land and land is definitely most likely going to retain its value, right? And you're renting it out, right? I think
Yeah.
that's
And
absolute genius. That
to me,
is
because I do both, like the mobile home park's a little bit more of a cash flow play. You're not going to have the huge pop of appreciation. You're not going to kind of get lucky. But if you want a good stable asset that just produce stable cash flow, it's the mobile home parks. But the apartments, that's where you're going to get that nice appreciation pop.
Oh yeah, yeah. And cash is king. So, I mean, if it produces
Yeah.
cash and it doesn't have any expenses, right? It really
Yeah, I
doesn't.
mean, either way, right? Like, people say cash flow is king, right? Like, I don't care, cash flow or cash. I'll take either at a certain multiple, right? Like, I can, I can take cash and pay myself cash flow, right? I can just stick it in the bank and pull out 5 grand every month if I wanted to, right? To me, it makes no difference. It's just
Right.
how is my net worth growing and what's my return on investment is the main thing.
Definitely, definitely. If you could give our audience and our listeners and our viewers, because we have some that watch us on the YouTube and some of them that watch us do or listen to us do our podcast, if you could leave them with one big piece of advice, and it can be related to investments, real estate, anything, what would that piece of advice be?
Yeah, I would say, stay in your lane. Like me personally, I've kind of I get a lot of shiny object syndrome. Like I look at self-storage deals, I look at venture capital deals, but the way I look at it, I know workforce housing, apartments, and mobile home parks. And I guess that way it translates, a lot of your listeners are very successful entrepreneurs and business folks. Like that's your highest and best use. For a lot of my clients, they're high paid doctors, lawyers, engineers, some business guys too, but their highest and best use is generating income in that stuff. But real estate, I think, is an end game strategy. Once you've accumulated a good amount of wealth, you got to be putting it into real estate. Real estate doesn't make astronomical gains. It's not a 30% return on your investment every year, but it's something that a lot of people have access to, and it preserves capital. And when you combine that with the fact that you can play all these tricks and games with real estate professional status and all these bonus depreciation for wealthy folks, this game is more about tax mitigation than really getting the highest ROI for your money.
Oh, yeah, Definitely. And the cash flow, right? It produces that monthly cash flow continuously, especially if you're using it for rental property the way that you are and that you're managing that for your folks. One of the things too is our listeners may not be familiar with capital gain rates, but capital gain rates, I mean, depending on your income level, they can be 0%. 15%, 20%. So imagine being in a 37% bracket and only paying 20% on tax when you sell this investment. Again, like Lane says, it's not just preserving your wealth, but it's a tax strategy too. That when you sell it, that revenue it's going to be taxed at a lower bracket. So it's a really
Yeah,
great opportunity from
we're
that
very
standpoint.
strategic on holding assets for what, more than a year? That's the magic number, right?
Exactly. So, Lane, tell us how our listeners and viewers can reach you. How can they find out more about what you do, find out how to invest with you? How can they reach you?
Yeah, so I have a lot of this stuff on my website for free. I mean, my whole goal was to be the anti-real estate guru and have people just get out of all the Wall Street garbage like mutual funds and retirement accounts and invest in real assets that more Main Street benefiting. So everything's on my website, simplepassivecashflow.com. I have the podcast. Yeah, if anybody wants to reach me, my email is lane@simplepassivecashflow.com.
I love that. So, guys, you heard that. You can reach Lane at simplepassivecashflow.com or simplepassivecashflow.com. Thank you, Lane, so much for sharing your knowledge with us and getting us thoughts about how we can grow our wealth in the future. So, thank you very much.
All right, appreciate it. Aloha.
Aloha.